Hello and welcome to your July investor update. I'm Pacome Breton, Head of Portfolio Management at Nutmeg. And in this update, I'll cover how we are managing portfolios in the current environment, what happened in financial markets in June, and I'll reflect on an action-packed first half of the year. Were there any key portfolio changes made in June? We changed our equity view to overweight in June, meaning our outlook is increasingly positive. And this follows an improvement in discussions between the US and its trade partners and increased confidence in the resilience of US economic growth. And this view has been reflected across risk levels. For higher risk levels, where we have greater exposure to equities, we have further increased holdings. We have reduced our fixed income exposure to do this and mainly trimming holdings in government bonds. We anticipate upward pressure on long-term bond yields due to high budget deficits on both sides of the Atlantic. And we have reduced our exposure to these assets to account for this. Given recent strengths in equity market performance, the equity exposure in our lower risk portfolios has gradually increased. And while we believe the equity outlook has improved and this would typically mean increasing holdings, to maintain the risk profiles of these lower risk portfolios, we have trimmed their equity holdings. Geopolitically, June was highly eventful, as this impacted markets. This month was quieter on the macroeconomic front. Inflation appeared to be cooling, and employment data remained supportive in the US, easing recession risk fears, and events in the Middle East had limited, albeit not insignificant, impact on market and oil prices, something almost unthinkable a few years back. In terms of market performance, June was a strong continuation of what was seen in May. In equities, there was strong performance from the US along with emerging markets. In fixed income, both short-term and long-term bonds performed positively in both the UK and the US markets. This strong equity and fixed income performance helped our portfolios to perform positively. It's worth noting the strength of the pound, which impacts our portfolios. While our fixed income allocation is entirely in sterling assets or GBP-hedged assets, our equity exposure is only partially hedged. Therefore, for higher risk portfolios, while they benefited significantly in June from positive equity performance, the strength of the pound is diminishing the positive contribution given our exposure to equity markets outside the UK. And the impact has been quite pronounced this year, with the pound up almost 10% versus the US dollar. And for more information on the role currencies play in investment returns, please take a look at the Insights section of our website for a recently published article. So how do you view the first half of the year? The first part of the year, especially the second quarter, has been almost unprecedented in terms of uncertainty. This was induced by the proposition to implement the largest tariffs in the US since the 1930s, a proposition that was reversed abruptly just a couple of days later. The impact on financial markets was extremely sharp, with one of the worst short-term losses for equity markets, soon followed by a strong recovery. By modestly reducing our equity exposure and gradually reintroducing risk in May and June, we aim to focus on long-term objectives. Trying to time short-term fluctuations in the markets remains hazardous, especially when they are induced by political decisions that can be quickly reversed. And one of the most impactful aspects of the first half of 2025 was the resurgence of Europe. Germany announced plans to increase its military spending to levels above any previous forecast, with a budget containing fiscal stimulus unprecedented since the German reunification in the 1990s. And this has the potential to be a long-term game changer for Europe and could bring a renewed level of dynamism to the old continent. How do you reflect on April's tariff-induced market volatility? The shock and the size of the US Republican administration tariff proposals were clearly beyond any market forecast at the time. And it was no surprise that the market reacted so strongly. The situation remains fragile, and it is difficult to fully understand the tactics of the US president and his administration. Our current belief is leaning towards a scenario where tariffs, while elevated compared to history, will settle at a much lower level, and growth will remain largely positive, even if lower than initially anticipated. The weakness of the US dollar, reflecting this level of uncertainty, will help US companies and their profit margins, while Europe continues to look relatively attractive for the reason mentioned previously. The situation continues to remain challenging on the macro front in China, even though its technological sector continues to innovate. We are therefore cautiously optimistic for the rest of the year, but volatility and uncertainty is likely to remain elevated. Thanks for watching. For more information on our investment view for the rest of the year, we will soon be releasing our mid-year outlook, so watch out for that one soon. And in the meantime, if you have any questions or topics you'd like us to discuss in the next month's investor update, you can contact us via social media, email, or in the comments below this video.
As with all investing, your capital is at risk. The value of your portfolio with Nutmeg can go down as well as up, and you may get back less than you invest. Past performance and forecasts are not a reliable indicator of future performance. We do not provide investment advice in this update. Always do your own research.